Today, more silly season stupidity. The market review for the 26th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's post, we look at what's been going on in the markets, and of course there's some buoyancy back because suddenly everything is rosy, or is it? An MSCI gauge of local stocks recorded its best week since April, thanks to the continuous economic recovery from COVID-19. Investors remain optimistic despite risks such as higher inflation, the prospect of tightening monetary policy, and the spread of the more infectious COVID-19 variants. In the US, the S&P 500 ended the week at record highs on Friday, lifted by Nike and several banks, while weaker than expected inflation data eased worries about a sudden tapering in stimulus by the Federal Reserve. Indeed, the reflation trade returned this week as federal speakers, including Chairman Jay Powell, eased concerns about tightening anytime soon. Nike surged 15.5% to an all-time high after the sneaker maker forecast fiscal full-year sales ahead of Wall Street estimates, helping the Dow lead among the three main indices. Federal Reserve announced on Thursday that the biggest US banks could easily withstand a severe recession, a milestone for the once beleaguered industry, and so will no longer face pandemic-related restrictions on buying back stocks and paying dividends. The Fed, in releasing the results of its annual stress tests, said all 23 institutions in the 2021 exam remained, quote, well above minimum required capital levels during a hypothetical economic downturn. Bank shares jumped after the release, and the scenario that they ran included a severe global recession that hit commercial real estate and corporate debt holders and peaked at 10.8% unemployment and a 55% drop in the stock market. While the industry would post around $470 billion in losses, loss cushioning capital would still be more than double the minimum required, the Fed said. If there was an anticlimactic note to this year's stress test, it's because the industry underwent a real-life version in the past year when the coronavirus pandemic struck, leading to widespread economic disruption. Thanks to help from lawmakers and the Fed itself, banks fared extremely well during the crisis. In fact, they stockpiled capital for expected loan losses that didn't mostly materialize. As a result, Bank of America climbed 1.9% and Wells Fargo rallied 2.7% after the Fed announced the big banks had cleared the stress tests. The S&P 500 Financials Index rose 1.3% and in fact was the top performers among the 11 sector indices. At the close in New York, the Dow Jones Industrial Average added 0.69%, while the S&P 500 climbed 0.33% and the Nasdaq Composite lost just 0.06%. And by the by, billionaire Richard Branson's spaceship company Virgin Galactic soared almost 40% and was Wall Street's second most traded company after receiving approval from the US aviation safety regulator to fly people to space. For the week, the S&P 500 gained 2.7%, the Dow added 3.4% and the Nasdaq gained 2.4%, and it was the S&P 500's strongest week since early February and the Nasdaq's strongest since April. Today is a bit of profit-taking in tech and a reallocation into the banks after the results of the stress tests, said Dennis Dick, a proprietary trader at Bright Trading, adding he expects banks to soon announce increased dividends. Elsewhere, a bipartisan Senate deal on infrastructure spending embraced by US President Joe Biden on Thursday also lifted stocks, with the materials and industrials indices increasing, and that helped to make the S&P 500 outperform the Nasdaq. The $600 billion infrastructure deal paved the way for investments in roads, bridges, and broadband. The deal was less ambitious than what Biden had hoped for, and that could explain Treasury yields and the US dollar remaining downbeat this week, despite the Fed's more hawkish stance. The group of senators has, quote, come together to forge an agreement that will create millions of American jobs and modernize our American infrastructure, Biden said. The bipartisan $579 billion infrastructure deal aims to create millions of jobs, and the move is expected to go through Congress alongside a separate bill that would spend trillions more on what Biden has called human infrastructure. Now that, of course, is opposed by the Republican Party. The positive news from the infrastructure package favours the S&P 500 more than the Nasdaq, because the Nasdaq does not pour cement into roads and put steel in bridges. That's the S&P 500, said Jake Dollarhide, Chief Executive Officer at Longbow Asset Management in Tulsa, Oklahoma. Infrastructure spending strengthens an already very strong economic growth outlook, LPL financial equity analyst Jeff Butchbinker told Bloomberg. These investments will bolster the outlook for corporate profits and should keep this bull market going strong well beyond 2021. But the latest personal consumption expenditures, the PCE data, showed a measure of underlying inflation that rose less than expected in May. Core PCE rose just 3.4% year over year, as expected. That's, of course, above the Fed's 2% flexible target. The key US inflation gauge monitored by the Federal Reserve rose for a third month, while personal income and consumer sentiment fell, showing growing price pressures against weaker buying from Americans. And this chart on a bad time to buy a house is a doozy. They had to redraw the scale. This should not be happening in a, quote, strongly recovering economy, as I discussed yesterday in my latest chat with journalist Tarek Brooker. In fact, stimulus is still being drained away. On the data side, 411,000 filed for initial jobless claims in the US during the previous week. That's above the 380,000 figure in forecasts, but slightly below the 418,000 during the previous week. And the volatility index was down 2.19% to 1562. That's a new 52-week low. So everything is calm as far as we can see. The bond market spent most of the week barely moving, but the long end of the Treasury curve saw some selling today as that core PCE inflation number came in at the highest rate in nearly 30 years. The 10-year Treasury yield rose 4 basis points to 1.53%, and that's closing the week out near the highest levels over the last 5 sessions. Next week brings the big June payroll reports. Fed officials have noted their disappointment in the employment number of late. We expect an above consensus reading on non-farm payrolls growth of around 800,000, signifying a meaningful acceleration from the May reading of 559,000, according to Bank of America economist Michael Meyer. We forecast that private payrolls, which excludes government employment, to grow by a robust 700,000. The better pace of hiring activity should push the unemployment rate down further to 5.5% from 5.8% previously. Another month of strong labour demand should again boost wages in June, pushing up average hourly earnings by 0.4% month over month or 3.7% year over year. It seems that where the US goes, so goes the world, particularly when Wall Street rises. That is certainly the case in Asia, where the US has given APAC reason to be cheerful on the commodity, machinery and electronics exports front. European stocks traded mixed on the final day of the week. The upbeat mood on Wall Street, which sent the S&P 500 to record highs, failed to inspire fresh highs in Europe Instead, concerns over travel dominated. The UK government widened its green list. That's the countries that British tourists can fly to without having to quarantine on their return. However, concerns are growing that the changes to the list were still too restrictive to relieve the key summer holiday period, leaving travel stocks out of favour. Meanwhile, in Europe, German Chancellor Merkel, along with French President Macron, are backing further travel curbs in order to prevent the Delta variant from spreading. Travel stocks across Europe remain under pressure. In London, the FTSE was outperforming its European peers thanks to a boost from energy and mining stocks, and that overshadowed the weakness in travel stocks. Higher commodity prices combined with a dovish Bank of England policy are making the UK market an attractive place to invest. The FTSE was up 0.37% to 7,136, while the UK Financials Index was up 0.7% to 866.18. The Bank of England was upbeat on its outlook for the UK economy, but in line with the Fed, the Bank of England considers that the spike in inflation will be transitory. And let's not forget that COVID cases are still on the rise and the furlough scheme will come to an end in the autumn. The UK is by no means out of the woods yet. The Bank of England remains in a wait-and-see mood, with accommodative policy-keeping stocks underpinned. In the currency markets, the euro is showing some signs of life, extending gains versus the US dollar for a second straight session, just slightly up 0.04% to 1.1935. And data revealed that German consumer confidence is set to jump in July. The closely watched GfK data rose to -3, up from -7 in June, and ahead of the forecast of -4. As COVID cases recede and the economy reopens, optimism is running high, which bodes well for a solid start to the third quarter. The DAX closed at 15,607, up 0.12%. In Japan, the Nikkei 225 was up 0.66% by the close to 29,066. The Tokyo Core Consumer Price Index was at 0% in June, but above the 1.1% contraction in forecasts prepared by a number of analysts, and the 0.2% contraction in the same month in 2020. In China, the Shanghai Index was up 1.15% to 3,607, while the US dollar yuan was down 0.22% to 6.456. The US dollar index futures was down 0.01% to 91,787. The inflation question still haunts the halls, with the Drewry Composite World Container Index up a further 15.9%, or $1,104 to $8,061 per 40-foot container this week. That is 332% higher than the same week in 2020. Freight rates surged on the Trans-Pacific lanes. For instance, rates on Shanghai, New York and Shanghai, Los Angeles soared 39% and 34% to $11,180 and $8,549. And Drewry expects rates to remain on the higher side in the coming week. WTI crude oil for delivery in August rose 0.91% to hit $73.97 a barrel. But lumber futures on the Chicago Mercantile Exchange have been nearly halved in a matter of a month, to $879 per 1,000 board feet, from the all-time high in May of around $1,711. The reason for the latest downdraft is because sawmills are boosting output and domestic production is increasing, catching up with demand. With the term structure of the futures market indicating falling demand and supply ramping up, Capital Economics released their forecast that prices may drop to $600 by the end of 2021. That'll be a relief, of course, from the 1,700 prices, but still more than double the prices from pre-COVID levels of around $300. And Bloomberg noted that 3,000 sawmills in the US are all running extremely hard, and supplies are beginning to catch up with demand as the summer begins. And that's an example of the bounce back from a deep fall following a recovery, and a further indication of how inflation can be transitory as supply adjusts to future demand. In Australia, the share market finished on Friday higher, despite Sydney announcing a lockdown in 4 local government areas. Both Australia and New Zealand remain on Delta variant COVID-19 tenterhooks, with parts of wider Sydney also entering firmer lockdowns. That has not dented sentiment, though, with the ASX 200 rising 0.45% to 7,308, and that was pushed higher by the materials and financial sector, with the financials index up 0.62% to 6,496. Friday's biggest gainer was Boral, which climbed 6.4% to 734 on news that Seven raised its takeover bid for the company. Kogan.com was the session's other major winner, advancing 6.1% to 1220, and shares in Boral rose to 3-year highs. All 4 major banks finished higher, with the ANZ up 0.9% to 28.28, NAB added 0.3% to 26.18, Westpac rose 0.2% to 25.89, and the Commonwealth climbed 0.6% to 99.26. Elsewhere, Adbury rose 4.5% to 344, New Farm advanced 3.6% to 487, and Orica rose 2.8% to 1357, and A2 Milk jumped 3.9% to 634. Nuix led the losses, falling 3.9% to 246, while Pilbara Minerals declined a similar amount to 149. Zipco tumbled 3.1% to 823. The local volatility index was down 2.72% to 1124. That's a new 1-month low. The Aussie rose 0.13% to 75.92. Now, gold clinched on Friday its first weekly gain in 4 since its unceremonious fall from the $1,900 level, but the difference was hardly anything to crow about. Gold futures for August delivery was up 0.28% to $1,781.70 US. It was a woeful previous 3 weeks for gold longs, who watched miserably as the benchmark futures contracting gold cascaded from 5-month highs of just over 1,919 to a 7-week low of just 1,761 at one point. That was a loss of almost $160, or more than 8%. In Friday's trade, the spot price of gold hovered at 1,779 late in the afternoon in New York, and traders and fund managers sometimes decide on the direction of gold by looking at the spot price, which reflects bullion for prompt delivery instead of futures. Conviction has become a rare commodity in gold as the average long investor tried to stay true to the yellow metal through its travails of the past 6 months. Since January, gold has been on a tough ride that actually began in August last year, when it came off record highs of above $2,000 and meandered for a few months before stumbling into a systemic decay from November, when the first breakthroughs in COVID-19 vaccine efficiencies were announced. At one point, gold raked up a near 11-month bottom at 1,674. Almost becoming a joke as well is the argument that gold was an effective hedge against inflation, or the best store of value in times of financial or political troubles. Gold will likely continue to stabilise going forward, as the majority of Fed Chairman Powell's policymakers agree with him that inflation will be transitory, Ed Moyer, analyst at online broker Honor, said. And over in crypto land, the notorious meme crypto asset Dogecoin has seen better days as the digital currency tapped an all-time high 2 months ago at 0.737 per unit. Today, Dogecoin is down 67% since that all-time high and over 30% during the last 3 months as interest in the dog meme coin is waning. Worldwide interest in DOGE is slipping as the search query Dogecoin on Google Trends has slid from an all-time high in interest. Dogecoin lost 79% by scoring 100 in the second week of May to this week's score of 21. The search query for the term Doge globally shows similar findings, as interest has been dropping across the board. Today, the most interested countries searching for the term Dogecoin on Google, included in the latest data, includes the US, Turkey, Canada, Singapore and the Netherlands. Dogecoin's price has dropped significantly since the last month, and during the course of the week, it's been sitting at around 0.23 per unit. Doge is down well over 16% during the last week and down 30% against the US dollar over the last month. Dogecoin's market capitalization was massive at one point in May, and it ate into Bitcoin's market dominance. But today, the market capitalization of Dogecoin is around $31 billion. And on Friday afternoon, on June the 25th, Dogecoin trade volumes was around $5.3 billion in global swaps. The most swapped coin with Dogecoin today was Tether, which commands 73% of today's swaps. This is followed by Bitcoin at 6.29%, the US dollar at 6.23%, and a few others, including the Turkish lira. Dogecoin is only down 7% on Friday, which is a lot less than most crypto asset percentage losses among more than 9,000 coins. In fact, some reports have said that Elon Musk's recent Bitcoin maxi tweet pushed the price of Dogecoin higher. However, Musk hasn't been tweeting about Dogecoin at least as much as he had been prior in his Saturday Night Live appearance. Despite being 67% down since its price all-time high, Doge has ways to go to shed long-term gains against the US dollar. Dogecoin is still up 335% during the last 3 months and 661% against Bitcoin during the same time frame. 12-month stats against the US dollar show Dogecoin is still up a whopping 9,739% to date. Leading coins like Bitcoin and Ethereum have seen nowhere near the same 12-month gains that Doge has. But with a low of 67% down from its all-time high, some Dogecoin owners are definitely holding on to heavier bags. Bitcoin was lower for the week at 31,940 at the time of writing. Opinion is still religiously divided on whether it's going to crash below 20,000 US dollars or recover further. In fact, I don't think there is any way to tell. And elsewhere, meme coin Shiba was seeing its prices buoyed, at least briefly, after a mention by guess who? CEO Elon Musk. The crypto, a meme of a meme, was swinging in and out of positive territory on Friday after Musk jokingly referenced the asset, another new coin based on a dog, but launched less than a year ago. The Chinese-based cryptocurrency Shiba, which was modelled as a fun crypto a la Dogecoin, has been drawing increasing attention among crypto enthusiasts looking for the next busy asset to ride to the moon. Shiba saw its value surge along with Dogecoin back in the spring as investors sought new meme prospects, including Kishna, which is marketed as a community-focused decentralized cryptocurrency with instant rewards for holders. SHIB, which features the image of a Shiba Inu hunting dog, is now the 28th largest crypto in the world. Dogecoin stands as the 6th largest, according to CoinMarket. At last check, SHIB was trading about 1% higher, while Bitcoin was down 1.3% and was changing hands at around $32,000. That's because the broader crypto complex remains under pressure due to China's ban on mining. SHIB has no apparent utility, but, similar to Dogecoin, has attracted a rabid fan base who are eager to help drive its value higher. Its creators refer to the token as the Dogecoin killer. And last month, one of the founders of Ether, down 2.51%, and the Ethereum blockchain said that he donated about 50.7 trillion in Shiba to COVID-related charities in India. The enthusiasm for SHIB and other Dogecoin copycats appears to be growing among those on the prowl for the next popular social media-inspired asset. It's hard to know if Musk's reference of the crypto on Friday was done purely in jest, but his social media mentions have tended to have outsized influence on the price of digital assets. Earlier this week, Coinbase Global announced that it would list AMP, an Ethereum token, on its platform, which was met with a number of customers complaining that SHIB hadn't been listed instead. Meme assets that trade on social media sentiment rather than fundamentals have been an unusual trend in markets. Assets like Dogecoin, as well as stocks like GameStop, AMC Entertainment, and BlackBerry have seen stratospheric rises in value so far this year, but critics caution that such trends could end in tears for buyers because they're just jumping on the latest bandwagon. Dogecoin was up nearly 5,000% so far this year, and SHIB had seen a similarly powerful percentage jump at this peak. My point here is that these are not investments. They're speculations. They might go up, they might go down, they might go sideways, they're completely unpredictable. So essentially, you could be throwing money down the toilet, or you could be actually creating something which could create huge value, but nobody knows. And that for me is a microcosm of the current silly season, where underlying value is disconnected from markets. It's very, very unlikely that the levels in the main markets that we have at the moment will continue much ahead, but they'll probably go a bit further higher and then come back. Who knows when? Who knows why? Who knows how? And if you want to learn more about what's going on in the markets and what might be ahead of us, join Damien Klassen from Nucleus Wealth and myself next Tuesday at 8 p.m. Sydney time for our live show, where you can ask a question about what's happening in the financial markets. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.